Great. So one of the pieces of information about me is I'm a lead in our industrials practice. The case we're going to step through today is inspired heavily by an actual case that we've completed. So it's a good example of the kind of work that we do. It's an interesting one, and one I doubt you would have come across before. But basically, the focus in a private equity oriented consulting interview is less about coming to a recommendation around, hey, we should go and we should build 50 more widgets, or we should move this manufacturing plant to there from here to there, something like that. The focus here is, should we or should we not invest in a business? And so just keep that in mind as we step through.
Okay, sounds good.
Cool. So I'll read this to you. The focus here is traffic doors. You've got a private equity client who's come to you with an unusual situation, and they're interested in investing in a startup that plans to manufacture traffic doors. Traffic doors are basically the doors you find at the back of restaurants, grocery stores, warehouses, etc. They flap. They're flappy doors. They're very mundane, things you may not have noticed before all around you. They are they're generally sold, I guess just one thing to keep in mind, they're generally sold through distribution to end customers, although the manufacturers have a good sense and keep relationship with those end customers. And other thing to keep in mind here is that the startup's not claiming any particular product advantage over their competitors. They are just saying, hey, we've got a new product, same as everyone else's, maybe slightly different, but we think we can make a case here. Their question is basically, one, how attractive is the traffic door market? And two, should we invest in this particular startup?
Okay, that is a very interesting case. I'll admit that I've never seen something like this before, but all the more interesting, I suppose. So I'm just going to run through what you said just to hear that if we're on the same line here. So we are looking at a traffic door startup manufacturer. Traffic doors being the casual day-to-day doors that you might find in restaurants, grocery stores, hotels, etc. The keyword here is mundane. There's no actual product advantage for this startup. And they sell them to distribution centers who then sell them to the end customers. And the question for us is, how attractive is the traffic door market? And should this PE firm invest in this startup?
That's right. So what I'm going to do now is step through a few slides with specific questions that build towards, the second part of that question there. All right.
Sure.
Cool. First question is this: how would you think about sizing the traffic door market? What variables would you think about putting into a TAM equation? TAM being total addressable market, i.e. the available revenue for all the players who are selling into the market in a given year.
Okay. So when trying to calculate the TAM for the traffic door market, I would look at a few variables. I'm going to run you through them and then actually do the math itself just to make sure that I'm not calculating the wrong numbers. So I would start by asking actually if this is a domestic market that we're looking at or an international market, because that does change the scope of it.
Good question. We're going to do US, and don't worry about numbers just now. I'm going to share a little bit more about that on this next slide. I just want at this point to get your thoughts around how generally would you think about sizing it if you had numbers?
Right. So starting with the US, I would look at all the businesses that fall under the appropriate target audience or target market. Like you mentioned, these are hotels, grocery stores, restaurants. Then I would look at the average need for each one of these institutions for traffic doors, right? Do they is it a double size? Is it two per room? How many rooms on average are there in these establishments? You probably have to come up with separate buckets for each category. Then you would look at replacement rate. So how often these doors break down, and does that change based on the institution itself? So is it between the restaurants, the grocery stores, the hotels, and And then if so, are there bulk orders perhaps that you order maybe like 10 for the next like 5 years? Or is it just you replace them as it goes on? And I would say that funnel scope to reach some sort of a final number in terms of the TAM on an annual basis for the the US traffic door market.
Great. Awesome. And you hit on a few things that are very relevant as we move to the next question here, which is we've gathered some data to help us size it. And my ask to you is, we talked about this a little earlier. You're welcome to do this in Excel just quickly, given the compressed timeline here. But basically, take a look at this information and tell me what you think as far as the market size.
Yeah. Okay. So we're seeing here the average lifespan of a traffic door is 7 years. That's good. Then the wholesale price of a traffic door is $1,200. But that's contrasted with the average retail price of a door, which is $1,400. So I can assume here that we have a margin of around $200 for our client, just off the bat there. The grocery store segment amounts for 50% of traffic door sales. Okay, that's interesting. So the other 50% would likely be the other categories you mentioned, like the restaurants or hotels. And there are around 40,000 grocery stores in the US. Okay. On average, each grocery store has 4 traffic doors. Okay, so based on this data, it seems to me that we're zooming in on just the grocery store segment, if there is a focus for our client there. And that new construction typically accounts for 5% of traffic door sales. So the majority is actually the replacement. That is very interesting as well. Okay, so with these numbers, I would start by figuring out how big this grocery store segment is, right? So it says 40K. I'm just going to jot down the numbers and then do the actual math in Excel. So that's 50%. So then you could assume that total institutions needing traffic doors are maybe 80K. That is an assumption. And on each grocery store has 4 traffic doors. Okay, so say we take that 80K number, that would be 3,200,000 traffic doors. New construction typically counts for 5% of the traffic door sales, right? So we go back to the start. If the average lifespan of a traffic door is 7 years, then they need to be replaced every 7 years. So basically, I'm going to divide this. I would divide this number by 7. And then before multiplying that with the $200 margin, I would want to incorporate the 5%. So that's 5%. So the replacement is 95% of traffic door sales. Let's see here. Average wholesale price. Okay. Okay, so perhaps I would calculate that number and then I could multiply it times 1.05 to add on the new construction for the other doors that are being constructed new. Does that all make sense?
So I think you mentioned you're going to multiply by margin, $200. Tell me about that. Have a think about that. Is that the best way to do it?
I guess no, because that would be going towards more and more sort of a profit analysis for our client, and we're just looking at the TAM. Thank you for pointing that out. Okay, so trying to understand the difference or how I could utilize the difference between the wholesale price and the retail price. Given that our client is not selling to the end client, but to the distributors, I would utilize the $1,200 price to calculate a TAM for a client. Does that make sense?
Yeah, and I didn't read this, but the prompt that says you don't need to use all the information.
Okay, perfect.
Sorry.
That is, so it's a red herring. That is interesting. Okay. Right. So I would, instead of using the $200, I would do $1,200 in this case. Um, so I would do $1,200, divide that by, no, so $1,200 times 80K for the total stores in the needing traffic doors. Then do that times four. It's four traffic doors per grocery store. I am making the assumption here, though, that the other 50% of traffic door sales are institutions that also make four traffic doors. So if needed, I can also just focus on the grocery store segment and then make a more broad assumption about the other 50% of the sales. And then I would multiply that times 1.05 to account for the new construction.
Got it. Got it. Okay. And what do you, if you math that out? Okay, so you're mathing that out. Let me ask this. So I said not to use all the information, but is that all the value of all doors being sold in a given year, or is that the value of all doors over a longer period of time that you're calculating right now?
Well, so if I were to divide up by 7, that would be the annual, I would say, replacement rate for the traffic doors. Because I'm assuming, yes, that's the only year span mentioned. Yeah.
Got it. Okay, so let's map that out and see what we get to.
All right. So starting here with $1,200. For the folks that can't see this, I'm doing this in Excel right now. I'm going to multiply that by, so you have two options. I can multiply it just for the grocery store segment, or I can multiply it assuming that the other segment is the same margin. But I can start with just the grocery store segment.
Yeah, that's probably a good idea.
Okay, so 40,000, which gives us 4,800,000. Then we are going to multiply that by 4 traffic doors. Which gives us 1.92 million. Is that right? Yeah, that's right. And then we're going to do that times 1.5 to no, not 1.5. We're first going to divide that by 7 to account for the lifespan, which gives us a very uneven number. So let's see here. That's around 274K. I'm correct. No, it's more. Apologies. I think I misread the earlier numbers. The earlier number would be 19 million, 19.2, and now we have 2.7 on an annual basis, and that's just for the replacements. And so we're going to multiply that times 1.5. 1.05, apologies. Which gives us 2.88 million. And that is the so 2.8 million is the TAM just for the grocery store traffic doors on an annual basis. If you made the assumption that that's half of the market, that would give you a round number of 5.6 5.6 million on average. But 2.8 is just for the grocery stores.
Okay, let's study this one more time. So you said 40,000.
Yes.
Times 4.
Times 4, right?
All right. And
times
then you multiply by 1,200.
Right.
And you got to 192 million.
Yes.
Got it. And then you multiply by 1.05, you said?
Yes. No, at first I divided by 7 because I didn't want to incorporate the new construction into the replacement rate. So I divided by 7. So that gave me 27 million.
Got it. And you got to 27 million. And Then you applied the 0.95 or 1.05.
Correct. And that gave me 28.8 million.
Got it. 28.8 million. Got it. And then you multiplied that by 2 to get the full market.
Correct. Right. I missed a zero there.
Got it. Okay. That's why I was confused. Great. Cool. Great. That's where we want to get to. I'm going to move on to the next question here. Now you know how big the market is, $28 million market for grocery. What do we say? Double that, 58, something like that for the whole thing. Your startup, we'll call them a target. Basically, they're bringing this. You've done some homework on the market. Let's just look at this exhibit here and have a think what it might imply about why they want to do this startup and what their prospects for succeeding with that startup are. No math, just read a Rorschach here.
Right. Okay, so we're seeing here that there's basically 4 major brands in this market that constitute 90% of the total market and 10% rests for the other brand. So that's a pretty consolidated market, actually. If I was a new entrant, that would scare me a little because it would be tough to fight for a piece of the pie when there's just 4 players that hold the majority of it. Now, brand A on top of that also almost as close to half of that market, so 40%. So that seems to be like a monopolized market almost for brand A. So if I was a new entrant, you would have to break that market share up for any of these new established players in this market. But then looking at the other graph, we see customer satisfaction. And here there's some variance where brand B seems to have, let's see what the metrics being used. So it's sample of customers interviewed by your team, okay, with 5 being highly satisfied and 0 being unsatisfied. So that's on the y-axis, and on the x-axis, okay, it's, I would say, the number of interviews done. Okay, so that's interesting that the sample size also differs, the differences between the brands. So brand B is not only very popular amongst those interviewed, but is also the most interviewed. So that seems to be more trustworthy than, for example, brand D, who only has 2 interviewees. So that's telling me that, for example, brand A or brand C, which are on the lower side, might be vulnerable to new entrants who could steal some market share there. Whereas brand B seems to be very solid. Now, brand E, I believe, would belong to all the other brands and has a poor customer satisfaction comparison to the others. But again, this is relative because all of them are close to 5, like around 4 and up. And that makes sense in my mind because we're talking about traffic doors. There's not a lot of customer preference or tailoring when you talk about traffic doors. It just needs to do what it needs to do, which is open and close properly. So that also might add to an extra barrier to a new entrant. There's not a lot of room for differentiation here. So if I was a new entrant, I would want to understand maybe why the other brands are receiving lower ratings than brand B, and to understand if there is some way to offer a better product or to differentiate, even though this is not looking too promising.
On the left side of the exhibit with the consolidation that you highlighted before, tell me if you are a customer of, let's say, your Walmart, are you happy about that situation, or are you not happy?
No. This probably is not in the favor of customers because besides there just being 4 major brands constituting 90% of the market, brand A, B, and C are also owned by the same parent company. So they can drive the price up as much as they like in this situation. And as a customer, you probably suffer a lot. So that might hint that there is room for competitive pricing. That if you were a new entrant and you could manufacture these doors at a cheap cost, you could steal significant percentage from these other brands. Yes, but so that would be an interesting option to look into.
Got it. Okay. That's helpful. And based on the right-hand side, how do you feel, it's just taking this as a sort of a flash, high level sort of data input. How do you feel the brands actually are digesting that potential price risk? What's their perception of that price risk right now?
So let's see. I think given the higher customer satisfaction ratings, I don't think that they'd see this as a big threat at all. If customers were reacting poorly, then that would show on this graph, and that would mean that there is a danger for competitive pricing. But if customers are happy with their product, then perhaps it doesn't even it doesn't matter to them too much the competitiveness of the price. So that is an interesting remark there, that perhaps the customers are not price inelastic.
Possibly. Is it also possible that this is a benevolent monopoly that's been maintaining price, not taking it?
It could be. It could be. Yeah, I would be surprised, as I've not seen too many benevolent monopolies, but perhaps this is just an industry where the product gets built and gets built well, and it's just done by a few companies, all owned by the same parent company, and it's not too much of a price war anyway, and then that serves the customers. It could very much be like that. Yes.
Cool. Cool. Moving on to the next question here. The startup's founder has pre-existing relationships with several of these large grocery chains, and they claim that these customers have expressed interest in buying doors from them. With the benefit of these relationships, they think they can hit $3 million in sales over the next 3 years, starting at zero, essentially. Based on the list of top relationships that, the founder, the management team has sort of identified that they're coming into the startup with, based on this list below, what's your assessment of that claim that they can hit that $3 million in sales?
Okay, so I'm seeing here a list of management relationships with different grocery store chains. Some names popping out like Target and Trader Joe's, but it's only really adding up to 4K in total stores. Now, 3 million is not a big number for an average manufacturing store. If a door, assume, costs something around like $50-$60, then reaching 3 million would only require you to only produce 200-300 on a monthly basis. That is very doable in terms of utilizing these relationships. So in 3 years, I think that is very doable if these numbers are true, and that these stores are willing to display the startup's products. But that would require breaking up that earlier, or at least relenting a little bit on that earlier monopoly that we saw on the previous graphs.
Prove to me it's possible that they can hit 3 million just with these accounts.
Sure. Okay, so in order to prove that 3 million is possible in 3 years, we would have to get some sort of a gauge on profit margins. So no, this is just raw sales. This is not profit.
It's all sales. Yeah.
Okay. So I would have to start making some assumptions unless you have data on the average price of a door, as well as what the retail price is within the stores themselves.
Ooh,
do we have any data there?
I do. It's the ones you already did.
Correct. Okay. So we said that 1,200 was the wholesale price, and the retail price was 1,400. So 3 million in 3 years we could say here at 1 million per year, but not necessarily, because sales do ramp up over time. Let's just break that down real quick in terms of what that looks like in terms of the amount of doors. So I'm just going to hop into Excel here. So in terms of wholesale sales, that would be 2,500 doors in 3 years. And if we look at the relationships that we have, and even if we were to sell one door in every single store with the chains that we have relationships with, we would be well beyond that number. We would be beyond 4,000. So in 3 years, I think that is very feasible.
How much? So what's the total dollar value annually that these stores are generating, do you think? How much?
Right.
How much revenue for all participants do they generate off these 4,000 stores? Is it even $3 million?
I see. Okay. So this is a profit question then, in terms of counting back or using the retail price minus the wholesale price.
Oh, and don't worry about profit. I don't think profitability needs to factor into this one. Just purely revenue. Could our startup reach $3 million in revenue off the back of these 4,000 stores out of the 40 that we know are out there?
I'm sorry. Could you repeat that question in a different phrasing?
Do we think that how many dollars in revenue would these 4,000 stores generate for the market, and therefore present TAM that we can go after? How much TAM essentially is embedded in these 4,000 stores, knowing that we have a TAM for the 40,000 stores already?
Okay, I see. Okay, so we said for the 40,000 stores, that was around a number of 288 million. So that would be 28 million. Sorry, we said 28 million. So that would be a number of the 2.8 million just for the 47 stores. So that is slightly below that 3 million target. But that is on a yearly basis. So 2.8 times 3 gets you a little under 9 million. So in that case, within 3 years, we are well beyond that sales target.
This is just a language thing, and the way this is phrased. $3 million in sales is meant to be like an annual number. So
I see.
Essentially, 0 1 year, we hit $2 million in sales the next year, $3 million in sales the third, something like that, right? And so you're saying there's $2.7 million in annual revenue baked into these stores. We want to hit 3. What do we do? Is that feasible? And let's say they can go beyond these 4 accounts to reach the $3 million target.
We are not far under, but it would. I don't understand. I'm not always trustful of the strength of these relationships, in the sense that these stores would every year be willing to sell a certain amount of doors and channel all those sales back to our client. So on top of not being able to hit that target number just with these stores, the strength of the relationship is I would say I would pull that into question. So it would be feasible if there was some sort of a differentiating factor, and we offer somehow a cheaper initial wholesale price than the other competitors. But again, it didn't seem like price competitiveness mattered. So I would be doubtful that we'd be able to reach that 3 million per year.
Got it. And that precedes the last question I have, which is, based on what you learned, what do you think about this opportunity? And what other questions haven't we covered that you'd want to investigate before rendering an opinion here on whether they should fund this investment?
Yes. So based on the data that we have now, would not invest in this business. And I don't think this is an attractive market to pursue. based off of, I would say, three major areas that we've seen. One, it's a very consolidated market for companies all owned by or three companies all owned by the same parent company. Two, price competitiveness doesn't seem to matter too much based off of the customer satisfaction that we saw, which was relatively high. And so there's no room for potential new price entrants. And now three, if all things go well and we can sell our doors in the stores with relationships that we have, we would still not hit that 3 million every year. So it's looking like this is a shaky investment, and in order to further investigate the opportunity, I would want to see what these relationships are built on. So what does a trust-based relationship mean in terms of just like numbers and sales? And two, I would want to look at ways our door could be in some sort of way competitive or differentiated. Is there a way that we can, in any shape or form, be provided something different than what our competitors are now providing? And again, this is traffic doors, so I'm doubtful. So those would be the follow-ups I would look into.
Great. One last then. Clients come to you with an investment idea. They don't like to be told they're stupid. They thought it was a good idea. You kind of telling them, no, I don't like it. It's a bad idea. If you had to offer them sort of an olive branch here and say, there is, what could you offer them in ways of, there is a path to make this an attractive investment. Are there other things that you could try to prove out here to say, well, it doesn't work in the context of these 4 accounts, but maybe it works if you believe some other things? Yes. What are the things what might you have to believe to make it work?
You would have to believe that we could build out these relationships with more stores and in an actual contractual agreement in terms of sales. And you could possibly look into the idea that this startup would get acquired pretty quickly if this is a consolidated market by the parent company, and that would be attractive to the investors because it looks like this market's very stable in the sense that it's so consolidated. So that would give a pretty quick turnaround in terms of the investment. That is a route to pursue.
Great. Okay. Well, with that, I think we're all done here. That was a really good job, Camille. That's fantastic running through that. A couple of things for me. One, you were very structured in your thinking throughout. You could feel it. I liked how you were, repeating things very clearly. I could hear where your thoughts were. It made it very easy for me to interpret, the strength of your thinking. And I like how you were very sort of regimented at the end. This is why we should do it for these reasons, pulling back on some things from before. I think that from a math perspective, obviously you got caught a few places. As I said at the beginning, I'm less concerned about, personally less concerned about the, numeracy things, we have Excel, et cetera. What I'm concerned about is that you kind of see the data and you know how to fit it together. And you did one small error when you have something like you've got 95% of the market and you're trying to gross it up to 100. You should take that number and divide by 95%, not multiply by 1.05. It's almost meaningless, but it's a silly little math thing. I think that in future for something like this, definitely, you got a crowd here, so it's not maybe a normal situation, but definitely feel free to take a little bit more time to really think through the step-by-step process and just look at the variables on a page as you think about multiplying them together. But obviously, you arrived at the right answer. The first, and this is why I want to give you another shot, because I thought you did the math right, but then I heard you say 2.8 million instead of 28. So that's why I wanted to go back with you on that.
Excel doesn't automatically sort the zeros, or at least I don't have that like current as a default function, which I felt silly counting the zeros. So I kind of immediately assumed what I saw, but I saw that wrong. So that was unfortunate.
That's all right. We put you on the spot here with Excel. And your point on 1200 versus 1400. That when you think about this type of a market, I guess just for everyone's benefit, generally there's going to be a couple of stages. You've got the $1,200 sale value to the distributor. The distributor then buys it for $1,200, sells it for $1,400. The $200 is the distributor's margin. We don't know actually what the margin of the startup was on the $1,200. They may have put $1 into making it. They may have put $1,199 into making it. They may have lost money on it. We don't know. But when we think about sizing something for a manufacturer, it's good for you to think about, well, what's the right revenue basis to do it on? Is it the value, the price that the price that the end customer sees, or is it the price that the intermediary sees who is buying it from the manufacturer on whose behalf you're trying to size?
That makes sense to me.
Cool. And then I guess last thing is I thought, again, very creative, just thinking around the edges. I liked your skepticism of, those relationships. I think it's really healthy, attitude to have about, when somebody comes to you with a projection, it's like, can you do that? Are those relationships that strong? And, as you think about one thing I'd on the last point, what else could you do, with this type of a situation? What else could they do beyond the 3 million? Well, that's only 10%. We only know about 10% of the market, right? They have strong relationships with them. Maybe they could get 10% of those doors. Maybe they get 90% of those doors. We don't know, but we also don't know that they can't get at least a chunk of the rest, So another way to look at it is to say $3 million out of a $60 million market is, like 5%. Is that doable? 5%, maybe over the course of 5 years, could they do that? So that's the kind of question we kind of run into.
Right. That makes sense to me.
Cool. And Camille, feedback from you on this. How did this compare to other things you've done?
Yeah, it felt good. I do like the private equity angle to it because it's like a hard yes or no. Should we invest in this? That doesn't end too often in a gray area. It felt silly to get caught into these math errors or the zeros. And I think this case felt very conversational, which I appreciated, but it also meant that I maybe didn't take the time where I could have taken time to just like jot down some notes. I was writing as we went along. But again, I think I leaned more so to the side of keeping the conversation going than structuring my thoughts. And in hindsight, I would do that differently. But overall, I think I'm happy with how it went.